Thank you. It's really a pleasure to be here today. I'd like to also acknowledge a former Cal Poly graduate who's now a master's student at Arizona State University, Jeremy Pagarin, and he helped me a lot with doing some background work on crop insurance, so topics I'm going to be talking about a little bit today towards the end of the presentation, and so I'd like to also acknowledge his help with this. And also, there's a paper that's going to be accompanying this talk. And so the paper is very much a tutorial, I think, in just general overview of risk management products. So I would encourage you to take a look at that when that becomes available as well. Before we get going, I have the hardest presentation of everyone here today for two reasons. One, it's right after lunch, and so that makes it really a tough time to talk. The other thing is that I probably have the most technical of the presentations that are being presented today. I will go through a few little examples with numbers and so forth. I'll try to keep those at a fair minimum, but I do probably have the toughest job today. Let me tell you a little bit about why I'm interested in risk management. And I think that given I'm talking to a group for people from California, you'll appreciate this. I grew up in Madera, California. I'm actually a Fresno State graduate, and I'm glad that Cal Poly actually invited me to talk today. From being a Fresno State graduate, there used to be a little bit of a rivalry there, if I recall. That was a long time ago, 22 years ago. But here's my interest in risk management. I had a teacher, a professor of mine at Fresno State, and he got me really interested in looking at futures markets. And I just became fascinated with the concept of hedging. And we'll talk a little bit about hedging here in a second. So I became fascinated with this concept, and I'm just thinking, wow, this is really interesting. What a neat concept. And I always tell my students, that concept of hedging and risk management kept me in school for 10 or 11 years as I got a PhD and continued working in this in my field of study. The other thing so I always was fascinated with futures and options markets, how they worked. I still am. There's still times I don't have a lot of I get confused at times, and so I always want to figure out new things about them. The other thing that got me interested in risk management was my internship in college, and I worked at a peach packing shed in Clovis, California. And I was sitting there with the sales manager, Ken Boyajian, by the name, that was his name. And I was sitting with the sales manager, and he's on the phone negotiating peach prices with buyers. And the price of peaches is just going down every phone call. Every phone call, the price of peaches is getting lower and lower and lower and lower. And I looked at him and I said, you need to be able to hedge peach prices. I said, that's what you need to be able to do. You need to be able to lock in peach prices and hedge those things. And so those two incidences in my life got me interested in risk management and thinking about risk management. Now, of course, hedging peaches is dicey. All right, so that's not easy by any sort of the means. But those two incidences, those two things got me really interested in risk management as a scholar, as someone that does research in risk management. So, in terms of thinking about today's discussion, I want to cast a wide net. I want to foster a discussion on risk management. I'm going to talk about a lot of different tools, in particular focusing on the pros and cons of various tools. And so in thinking about this, I want to really foster towards the end of the presentation a good discussion. I'm guessing many of you are much more familiar with these tools in terms of your own personal experience with them than I am in terms of actually engaging in these products. So I hope that today's presentation is really is really something that can foster discussion. And it was interesting listening to Dan, the first person today, talking about risk. What his title was. He said he was a pig farmer or something. That was his other title. I always say, as an ag economist, we're just pig counters. People always ask me, people that are not in agriculture, they ask you, what does an ag economist do? I said, well, we count pigs. We don't raise them, we just count them. So a little bit of overview what I'm going to do. I'm going to talk about some measures of risk. And I think the first step in thinking about risk management from actually implementing risk management strategies is to first think about risk measures. And I know Dr. Zilberman had talked a little bit about risk measurement, and I'm going to kind of lead into a little bit deeper discussion about risk measurement. Then I'm going to we'll actually look at some individual risk management tools. And the tools we're going to look at, futures, options, crop insurance, and some other thoughts there. And isolate the pros and cons of each one of those. And then the next thing I want to do is I want to provide a little bit of results from a simulation. And the simulation that I'm going to look at is actually for implementation of some risk management strategies for a naval orange operation, or hypothetical case study, a naval orange operation in the San Joaquin Valley, and look at how some various risk management products may actually perform, or what their probability of performance is. And then at the end, just kind of generate some what I call random thoughts, because as we'll talk about here, risk is very much related to random variation and what's to happen. So some random thoughts towards the end of the presentation. So the first thing I want to cover is, measures. Risk measures. How do we define and measure risk? That's the first thing we need to think about. Before we can think about any sort of implementation of a risk management tool, we need to really define what is risk. How can we measure the risk? And the picture that I picked there with the dice, the rolling of the dice there, is not a random picture. But what it does show is it gives us a little bit of insight into risk measurement to a certain extent. Now, in this cartoon, which you have in your packet as well, is an interesting little cartoon, because it says, if you can, it's a little blurry up there, but it says, we've got a bunch of people sitting around a boardroom, and it says, we've considered every potential risk except the risks of avoiding all risks. Now, you can interpret that little cartoon in lots of different ways, but in thinking about Mark Littlefield's talk earlier today, he mentioned a concept called enterprise risk management, and he talked about that, and he said that that's an important way to think about risk. And the whole idea of enterprise risk management is that we should look at the risk of a firm very holistically and not in silos. We can think about, individual risk, for instance, we'll talk a little bit about yield risk and price risk and so forth. But what about all those other risks, policy risks? What about risks of new technology and all those things that Dr. Zilberman talked about earlier? So the concept of enterprise risk management, I think that this cartoon kind of helps us think about enterprise risk management a little bit, is to think about the risks holistically, kind of as a portfolio of risk. And what we often see when we start really enumerating the risks that a firm may be exposed to, when we start doing that exercise, we think about risks that may or may not be correlated. We can think about risks that we can indeed manage with certain types of tools. And we can also think about risks that, we just can't manage at all, or we just can't think about at all. The true risks out there are the ones we've never even thought about. And I'll allude to that later on. What are the risks we can't even think about? And so I think this is an interesting cartoon. And the other thing is what this says is, we're all in business. Everybody that's in business is taking risks in general, and you've accepted that as especially in agriculture, you've accepted the idea that, hey, you are going to take a certain amount of risks to be in this business. So I think that cartoon is interesting enough in and of itself for that matter. In thinking about risk management, the first thing that we need to think about is this concept of uncertainty of outcomes versus just bad outcomes. Because risk managers, my little statement below there, risk managers and academics alike consider both the uncertainty of outcomes, good and bad, and the probability of bad outcomes when measuring risk. Oftentimes, when we think about risk, we're thinking of, bad things happening. And I think that that's a very intuitive way to think about risk. Interestingly enough, though, a lot of the risk measures that we look at, in particular the concept of a standard deviation, really is looking at uncertainty of outcomes. And so some of the tools that we have available to us can reduce the uncertainty of outcomes, as well as perhaps reduce the downside risk or bad outcomes happening. So this is a very academic issue, but it has practical implications for how we measure risk and for how we ultimately manage risks as well. So my wife said, do not throw a probability distribution out there for that audience. She says, do not do that. And I said, I won't. I promise I will not throw out a probability distribution. But I did want to talk a little bit about the concept of risk and uncertainty. And the reason I want to present this is because this is how a typical risk manager would view risk in terms of measuring risk. And this is how most of the academic studies that are done about risk management also view risk this way. So most of our risk measures rely on this concept of the uncertainty around a mean value. That risk is really defined as that uncertainty around whatever is the average, so to speak. And we can think about good outcomes being to the right here, and bad outcomes being to the left. And the worse the outcome, the farther out in the tails that we would say of the probability distribution. And of course, we have better outcomes along this scale here. And so one of the things in keeping, the academic literature in terms of risk management now is very much thinking about, the concept of not only just uncertainty around the mean, but also thinking of bad outcomes. So there's this concept called value at risk that was really implemented by the banking sector, and some would say, hey, they don't do a very good job at estimating or using this value at risk measure. I mean, when I'm talking about the banking, I'm talking about, for instance, J.P. Morgan in terms of how they manage their trading assets, because they use this type of system. But the idea of a value at risk measure is to say, hey, with some sort of level of confidence, can we estimate what our downside risk is going to be? So I'm just threw some various, just some random number out here and said, well, let's say at a 5% level that our worst case scenario is $20, a revenue, let's say, of $20 or a price of $20. So that would suggest that if we can say that, and we can usually use historical data to make some sort of estimation, that we have a 95% chance that our outcomes are going to be to the right, and only a 5% chance that something bad is going to happen, that our outcomes are going to be down here. I always say that the industry that understands this better than any other industry in the world is this second most famous industry in California, and that's Hollywood. Hollywood understands this concept better than any other industry in the world, and I'll tell you why. Anybody ever watch a reality TV show? Has anybody ever watched a reality TV show? And reality TV is an interesting phenomenon, because the people that are on a reality TV show, what are they paid to be on a reality TV show? They get a free hotel room and a dinner and a travel to an exotic location. Okay? So that's what someone gets. And so if we can think about the population of the United States, and this is how I explain statistics to my undergraduates. I say, hey, if we can think about the population of the United States as being kind of this distribution of around the mean, and up here in the positive tails of the distribution are Nobel Peace Prize winners and people that are doing wonderful things, and down here in the lower tails of the probability distribution, we have reality show contestants, or whatever you call them, stars, or Jerry Springer. Has anybody ever seen the Jerry Springer show? Jerry Springer understands this better than anybody, because he says, hey, I don't have to hire actors because I know that 1% of the population down here is about 3 million people in those bad outcomes. And the interesting thing about a bad outcome is that oftentimes we find empirically that bad outcomes cluster. So when there's a bad outcome, something that's below this 5% confidence level, that they often repeat themselves. And we find that in the insurance industry is cognizant of that. But empirically, we find that there's these bad outcomes that occur. So just kind of a little bit of a way to motivate this. To think about then, what are our risk management tools that we want to implement? And thinking about the implementation of risk management tools, the best way to think about that is that we want a risk management tool that does the following. At least this is the conventional wisdom of the line of academic literature that I'm in, is that we want to reduce uncertainty. So if we take a look at that top line there, this is if we have our mean level here, or our average, then our uncertainty is the width, so to speak, of around the mean. So it's that spread around the mean. So a risk management tool, a good risk management tool, should ultimately then reduce the uncertainty of that outcome, should bring in that spread of that outcome, and also be mean enhancing. So in essence, a really good risk management tool could be one that we can actually make some profits or increase means in the long run, as well as push that, or push, or even better yet, truncate this concept of value at risk and push it this direction. And so a lot of our risk, for instance, in the futures and options literature that I work in, they're always looking at how much uncertainty can be reduced from a hedging program. And could that hedging program potentially be mean enhancing over time as well? And so that's just a kind of a really simplistic diagram in terms of thinking about what a potential risk management tool can do. So again, just to kind of summarize, our best risk management scenario, and I'm talking this is the best case scenario from a long-term, in particular thinking long-term implementation of a risk management tool, is to reduce the standard deviation. reduce that uncertainty around some sort of mean level, to shift or truncate that value at risk, to push that, to reduce that bad outcome occurring, and to ultimately increase our mean or our average. And so those are some things to kind of keep in mind of, the design of, we can talk about futures and options and so forth, but what's ultimately the objective? And I think a lot of that, can be considered in that. So my first little example that I give here, and it's a very contrived example, but it illustrates and demonstrates this concept, is the idea of enterprise diversification. This is one of the most common, I think it was Stephen Blank wrote a paper in 1995 as a result of a survey from California growers on what the most popular risk management tools were. And Stephen Blank's an extension professor out of UC Davis. And from his survey, enterprise diversification was the primary risk management tool, one of the main risk management tools that were being used by California producers at the time. So I want to show just a little empirical example of the power of diversification, and it kind of gets to the summary of thinking about what those two little diagrams that I was just showing were. So this is a very contrived example, but just we have a 100-acre farm, 50 acres in navel oranges, and 50 acres in apples. So a 50-50 split in this portfolio. So we're really thinking about this farm as a portfolio, no different than how, let's say, a mutual fund would look at a portfolio of stocks. We're looking the farm now, we're looking at it as a portfolio of revenue generation through different crops. So our historical correlation, and I'm using NASS data, National Ag Statistics Service data here for prices and yields from 1990 to 2009, where we receive a revenue where revenue is just our price times yield. So I can completely, just built this simple little model off of this NASS data from 1990 to 2009. Now again, this is based on historical data, which has important implications for risk measurement, and so we need to keep that in mind. But the mean, if we take a look, if 100 acres were just in navels alone, the mean would have been $2,744 per acre. Now, I'm just looking at revenues based on the NASS data. This is not reflective of any individual farm, just really, based on these average data. And then for apples was $3,845, and this was not one particular variety of apple. This was, apples. The data was very much aggregated. So the numbers, and then for the farm ultimately, because 50% of the farm was in apples and navels, the farm was in essence a weighted average of the portfolio of apples and oranges. All right. The standard, because of the correlation, there was a natural negative there's a negative correlation of about minus 0.15 between navels and apples. So what we see is if the standard deviation historically was about $607 around the mean. So that suggests that about 68% of the outcomes around the mean of 2,744, about 68% of the outcomes fall within plus minus $607 of this number here, and so forth. So the apples, we'll notice that we had a higher mean, but also a higher standard deviation. So there was more risk in terms of uncertainty of prices around the apples than there were the standard deviation. Now, one of and then finally, if we look at it from the farm level, notice how what we have is we have a mean that's a weighted average of the navels and the apples, but the standard deviation went down considerably between the two. So the actual uncertainty by having that diversification, empirically, we can show this with historical data, empirically having that diversification was really important. And that was really primarily, and I actually looked at data that there was where there was a natural negative correlation between apples and navels. And so our standard deviation is reduced, and that's really what we consider what's called the portfolio standard deviation. We can reduce the standard deviation of this two-asset portfolio. And mutual fund companies are very, very cognizant of this fact, and I think it's an important concept. The other thing is that so through that diversification, we reduced our standard deviation and then also shifted or truncated that value at risk more towards the right of that distribution. So now there's only a 5% chance that revenues would be less than $2,400 relative to $1,700. And then the concept of a coefficient of variation is a measurement of mean or the standard deviation or risk relative to the mean. So you want the smaller the better for this number. So we've actually reduced our level of risk for a given level of mean just through that diversification process. And so that's just an illustration of one tool. And, as a risk manager, how do we empirically think about these things? So this concept of risk measurement, in my opinion anyway, is a tool in and of itself. And I think it's before we can jump to, hey, let's just start using tools, we need to think about how these tools are going to perform ahead of time in terms of how they are going to change the uncertainty around the mean, how they may shift that mean forward, or how they may truncate the downside. And now all this is reliant on historical data, which the quote-unquote financial industry, the people that are involved with mortgage lending in 2005 to 2008 and so forth would say, oh, you know what, the phenomenon that we experience is way outside our data set. It's way outside the data. And so the bad risks are the stuff that the data can't pick up. And I think that's an important thing to keep in mind, and I'll reiterate that as we go through. So, after thinking about diversification and after thinking about measures of risk, and thinking about this concept of standard deviation, which is that uncertainty, and ways that we can truncate the downside, I want to look at some individual risk management tools that we have available to us. So the big question is, that I always get is, Mark, what's the best risk management strategy? What's the best way to hedge? And Dr. Zilberman said hedging is, I forgot the actual term that you use, but it's complicated. It's not easy, and it takes some skill. And I'll emphasize that, and I'll illustrate that with one of my examples of where that skill is necessary. So it really depends, and that's a very wishy-washy answer in terms of which tools are best, but it's true. Which tools are best? It really depends. It depends on a lot of things. And I think most importantly, the tool that's important, what tools are best are, what's the appropriateness given the type of operation? Clearly a naval orange operation in Fresno, California can't really use futures and options to hedge orange price risk. I learned that when I worked at the packing shed back in 1991. It's like, wait, there's no futures contract for peaches, and there never will be. I don't think there ever will. I tried it once as a graduate student. My master's thesis was I was trying to develop a hedging tool, an exchange-traded hedging tool for produce. And so I said, hey, can't we link together all produce and call it and create an index where it would be highly correlated with certain fruits and vegetables, and could we financialize that and use it as a hedging tool? And it was really a neat concept, and that's where I'll leave it. It was really a neat idea for a young researcher who was very pie in the sky but didn't understand the realities. It was a neat idea. It was the most creative idea I ever had. I'll still say that to this day, but it didn't go anywhere for many reasons, but still an interesting idea. The other thing is what are the risks that need to be managed? And we really need to look holistically at what risks need to be managed, and really what risks can we manage? And then finally, and I think this is really important, what's the individual grower or user's comfort level and appetite for risk? I talked about risk management with one of my colleagues in the produce industry one time. And he says, look, I'm in this industry because I love the game. I love the risk. I love to time the market. I love all this. So the whole idea of risk management to him was kind of is out there. My father and previous generations have always dealt with this risk, and we thrive in it, and we manage well in that. And so you really have to think about what's your risk appetite for any particular tool that you may look at. And I think that these are some really important things to think about in the overall matrix of risk management. It really does depend. So what are the tools that I'm going to look at here and outline? I'm going to look at a little bit about futures, exchange-traded futures, options, forward contracts, as well as crop insurance. And so those are the things I want to look at there. And I'll start out with futures, which is my first love. My first love is futures. I always was just fascinated with futures, thought that they were amazing risk management tools. I did my PhD at University of Illinois, worked in their Office for Futures and Options Research Center. That's where I just always found these instruments to be fascinating and continually learn more about them all the time. People say, well, are you an expert in futures and options? I'll say, no, I'm a scholar of futures and options. I find them fascinating, interesting, and I like to learn more about these markets because they really are interesting. And one of the important things is you know, farmers, I think a lot of surveys have suggested that people that are actually directly in production agriculture, only about 5% actually are engaged in hedging directly themselves. But futures are really important to have a good, solid understanding on for a couple reasons. One is they're really important from a price discovery perspective. So we can look to the futures market and we can, you know, that's in theory our best forecast for what prices may be in the future. We could look to the milk futures for the next month, and that's what the market is in essence forecasting the price to be, or corn futures or what have you. So they really are important from price discovery. The other thing is that at least for what I kind of call the typical program commodities, wheat, corn, soybeans, et cetera, you know, there's the forward contracting arrangements that people get involved in are often the risk is offset by the entity that is providing the forward contract, and they're using the futures markets to offset that risk. And they are in a better position in terms of capital to often do so. And so that's why it's really important to kind of understand futures for that matter, or for that reason. Just from the pure definition as a risk management tool, futures contracts allow the hedger, and we'll assume the farmer in this situation, to lock in a price, and that's important to think about this concept of locking in a price of a commodity input or output by taking the opposite position in the futures market relative to the cash. So the whole idea is to do something opposite to what your actual risk exposure is in the quote-unquote cash market, which is the market you're actually dealing with. So the example that I provide here is a very textbook example, but I think it illustrates the use of futures and also illustrates some of the risks of using futures as a risk management tool, especially in the cotton market, because there has been some interesting things that have happened in the cotton futures market as well as for cotton producers and so forth. The example that we have here is a cotton grower, and the cotton grower is what we consider to be, in this situation, long the cash cotton. So the cotton grower's exposure, you know, they actually have the cotton, whether it's physically they have it or it's in process growing. The example I'm going to provide here is an example where the cotton grower actually has the cotton in the ground and is ultimately anticipating to harvest that cotton in the fall and then sell that cotton to a gin or other entity. So their position is what we call long the cash market. They physically, in essence, have the cotton or will have the cotton soon through the production process. So they're then going to sell futures contracts to hedge the potential price decrease in the future. So they're concerned about prices decreasing between the time that they plant and when they actually harvest and sell the cotton, so they're afraid that prices decrease, and they're going to take the opposite position, which is selling or going short relative to the long position. So I have this little example in here, and this example is an interesting example to walk through because it does illustrate some of the risks associated with a typical futures hedge. So when we typically set up any sort of futures hedge, again, this is the cotton grower is long, takes a short position in futures. We have what we call the classic T diagram. So on one side we have the cash market, which is the actual physical selling of the commodity, and then we have the futures contract. Cotton futures are traded on the International Commodity Exchange, the ICE exchange, which is now a completely electronic exchange based out of New York. And I think they're calling right now, so I don't know. But so on the cash side, let's assume it's July 1st, okay? So the farmer has planted their cotton, and currently the futures price is 85 cents per pound. These are fairly reflective of today's prices, or at least it was when I was putting the presentation together. And the December futures on July 1st is 85 cents, and in the cash market, we're assuming that the cash price at that time for this particular location is the same price. This is a very naive example, or what we call a zero basis risk example. So the farmer is long, in essence, in the cash market, 85 cents on July 1st. They're afraid that the price come November 15th, when they're actually going to harvest and market their cotton, they're afraid that the price is going to go down. So they take an opposite position in futures by selling December futures at 85 cents. November 15th comes along, and the cash price indeed goes down. It goes down to 75 cents per pound. So implicitly, from July 1st to November 15th, they've lost 10 cents per pound. in the cash market. But assuming that prices in the cash and futures move together, and in this example, the very naive example, the cash and futures prices move perfectly together, which is, again, that's a naive example, and I'll get a little more complicated here in just a second with that. That is completely off. If they sold at 85, bought back at 75, they gained 10 cents, and so those two things are completely offset. They've, in essence, sold at 75 in the cash market, and they add back their futures gain of 10 cents, and that leaves them with the final price received of 85 cents. They've, in essence, locked in that price that was on July 1st. So that's the idea of risk management. In fact, we know exactly from that what that, in terms of locking in price risk, and there's lots of risks, as we've talked about. In terms of locking in price risk, we know exactly what that price is going to be, assuming that what we call the basis, which is the difference between cash and futures. If we subtract cash minus futures, that's the basis. That relationship between cash and futures is really driving this whole thing. And so that's the next example is what we refer to as a short hedge. It's still a short hedge. And we have a price decrease, but now we have what's called a basis loss. So in essence, anytime that someone is engaged in the futures market, they're trading this concept of basis risk for price risk. Or excuse me, reversed. You're getting rid of the price risk, the risk of absolute prices moving, but now you're trading that with this concept of basis, which is the differential between cash and price and futures. And that's what's really ultimately at the end of the day drives the result. So same scenario. We have the grower sitting back at July 1st. The cash price 85 cents, futures is at 88. The cash minus futures basis is minus 3. So that means futures is above cash price by 3 cents. November 15th comes along. They sell their cotton in the cash market for 72 cents, implicitly have lost 13 cents on the cash side of that transaction. If they sold in December, sold futures in December futures at 88, now they buy back at 77, they gained 11 cents. Now notice that that's not a perfect offset. There's a 2 cent difference there, isn't there? And so in this situation, notice that the basis, the difference between cash and futures, changed from when the hedge was set to when the hedge was lifted. And the basis on November 15th, if you take the cash, 72 minus 77, it was minus 5 cents. So we would say, in futures language, we say that basis widened. That basis widened or it weakened. And that results in what we call a basis loss to the hedger. So the hedger was not able to lock in 85 cents as they thought. They're actually locking in 83 cents. It was still better than 72 cents, but they did indeed receive a basis loss because that change in that price differential from when they set the hedge in July to when they lifted it in November. This is then an example of a basis gain. So just like you can have a basis loss, you can actually have a gain. You can benefit from this differential in prices of basis. So same scenario, July 1st, long 85, sells December futures at 88, the basis is minus 3. On November 15th, then, they sold in the cash market for 74, and the price did indeed go down. They lost 11 cents there. But in this situation, they buy back the December futures at 75, and they gained 13 on the futures side. So the basis now from when they set the hedge was minus 3. So futures were greater than cash by 3 cents. When they lifted the hedge, now the basis was only 1 cent. So the cash price was 74, futures was 75, and the basis is minus 1. So we would say in this case, the basis actually narrowed. It narrowed. And so therefore, this is great. This is a great situation because now the farmer got 87 cents per bushel, or excuse me, per pound of cotton instead of 85 when they locked in their price. So again, to figure out the final price received, the cash price on November 15th was 74. That's what they sold it for in the cash market. They add their futures gain of 13 cents. And that gives them a total of 87 cents. And so that's a 2 cent basis gain relative to when they locked in the price because the basis went from minus 3 to minus 2. Minus 3 to minus 1. There's a 1 or 2 cent differential there in the basis. So that's an example of basis risk, but a positive basis risk. That actually was a benefit to the hedger. Now I wanted to note in your notes, for some reason, This slide copied exactly to this slide, but I just had the headings differently. So do note that in your notes packet. In the paper, it's correct, but in your notes packet, I for some reason that didn't transfer right. So I apologize for that in illustrating that example. So summarize a little bit of that. Does anybody have any questions on what I did there? Well, here's some of the pros and cons then of futures. Futures, let's think about the pros first. It allows us to lock in prices. It reduces that uncertainty of what the price may be. But in basis risk, actually, this concept, the movement between cash and futures can actually be a benefit if it's a basis gain. Futures have the opportunity of being what we call mean enhancing if you're a good price forecaster. If you're most of our studies show that, hey, if you can forecast prices into the future, which is very difficult, and if we can all do that, we'd be all infinitely rich, right? But if you can forecast prices, you're relatively good at forecast prices, you can hedge when you have to. When prices are high enough and offering you good profit margins, you should hedge, and that could be mean enhancing. It could shift that mean to the right. One of the really good things about futures is they are exchange traded. They're exchange traded, they're transparent, they're regulated. There's not a lot of riffraff in that regard. They're liquid, they're transparent, they're regulated. I guess I just said that. Some of the cons, limited upside potential. The only upside potential you really have using a futures hedge is basis risk, if it benefits you. If the basis goes in your direction, then in essence you can benefit from that. But limited upside potential, you're locking in a price. So you can't take advantage. So this really hit the cotton people hard. If they were a lot of cotton growers that in this last marketing year, back in October of 2011, October of 2010, they were realizing prices in the 80s, 80, 85, 90 cents per pound, and historically had been 50 cents per pound, 60 cents per pound. Of course, California prices tend to be a little bit higher because of the extra long staple. But hey, let's lock in 80 cents per pound. Let's lock in 90. And then all of a sudden, whoa, what's happening? Oh, it's going to, $1.75 per pound. I mean, it's going to, ridiculous historic highs. And they got, wait, I locked in at 80 cents. So they didn't get that upside potential. And so you can also have basis losses. That's another con in terms of futures. And then we would also say that routine hedging, if you did this all the time, forever, if you always routine hedge, you'd basically in the long run get the average price. And so really that gets back to it's only mean enhancing if you're really a good price forecaster. I think I'm solidifying everything Dr. Zilberman said about the complexities of using a futures hedge. Not applicable for many California businesses. I mean, bottom line is any specialty crops, it's really tough. Maybe perhaps though you can hedge some input prices on the energy side or something, but not in terms of output price risk. And then this is really a kicker, or the margin requirements. To enter a futures trade, you have to post margin. And in the example of the California, or the example of cotton this last marketing year, when prices were going way up and you were short futures, you would have to continually make margin calls, continually pay the broker those margin calls to stay in the hedge. And really that wiped out many cotton brokers, long-time cotton brokers, because they just did not have the liquidity to maintain those margin positions and to stay in the hedge when the prices were, actually the cash prices were going in their favor. So that was really detrimental to them and to the use of futures. I think it put a black eye on the use of futures and makes it more difficult in terms of that being a risk management tool. So then let's go to options really quick. An options contract provides the right but not the obligation to take a position in the futures market at a particular price over a given period of time for a premium. So the same example, a cotton grower is long cash cotton, buys a put option. A put option allows you the right but not the obligation to go short in the futures market to hedge a potential price decrease. So what the nice thing about an option price is it allows us to take advantage. It's very much like insurance, and I like to show this example because this is very much taking out an insurance contract on price. And so for instance, this is the strike price. This is the price that allows you, the price that you can potentially go long at, go short at. This is the premium you have to pay. This is like your insurance premium. You always have to pay that premium regardless. You always have to pay that premium. And so the floor price, the worst price that this farmer could potentially get, barring basis risk, which I ignore in this example, is 80.5 cents or 80.5 cents per pound. So these are what we would consider. So for instance, let's say they buy this contract at 85 and the price goes up to 110 cents per pound, $1.10, all right? In this case, they would never invoke that option. They would never exercise that option and take advantage of the fact that, hey, prices are way up. I didn't lock myself into some stupid futures contract. And nice thing is I didn't have to post margin either. All I had to do was pay that premium. And so you basically in that situation, let the options expire, but you just still pay the premium. You always have to pay that. When prices, if they went down, so for instance, if they went to 60 cents per pound, then you would actually take whatever the futures price is, 60 cents per pound, and you take the difference between that strike price and the futures, and then still subtract that premium, and you would ultimately get the floor price. So everything less than 85, you would just receive the floor price. That's the worst that the prices are going to go, barring basis risk, and that's one thing I didn't include in this example. But really, this is in essence price insurance. So you let the upside run and you truncate the downside. That's the big takeaway from an options. But they have their pros and cons too. In fact, my students will always ask me, why doesn't everybody just use options? Why these are just wonderful instruments? Why doesn't everybody use them? And there's some pros and cons. These are the same pros under futures. We still have basis risk. They are indeed exchange traded, so they're regulated, exchange traded, very liquid, very transparent. And the big pro of an options contract is it gives you upside potential. You get that upside. You can take advantage of prices going in your favor. There's no margin requirements when you buy an option. Now, selling options is a different animal, and I don't want to go into I could talk a year about that too. But there's no margin requirements when buying an option. You just pay the premium, and that's your payment. So their hedging costs are in essence known. And price risk management is very flexible with options. If you work with someone that's a really good in understanding all these instruments, you can customize things with options very easily. Some of the cons, the same as futures. Basis risk, not applicable for very many California commodities. And the premium is a wasting asset. But all insurance premiums are wasting assets. I mean, I like to talk about life insurance. I pay life insurance premiums, and guess what? I pay term life insurance, and I hope to God never to cash it in. Okay, I want to outlive my insurance policy. I don't ever want to cash it in. I never do, because I'm not going to get to enjoy it. Just my wife and kids will get to enjoy it. But I don't ever want to cash it in. So same thing with car insurance. So indeed, it is a wasting asset. You don't get those premiums back, but it does provide protection. One of the most important drawbacks of an option strategy is that those premiums get really expensive when the markets are really volatile, like we see today. So, yes?
I noticed on the pros you didn't include the intrinsic value when it's in the money.
That's right. So the intrinsic value will go up, and then you can ultimately sell. It's really the same thing. If you buy an option at a lower price, and then that intrinsic value is going to raise, and then you can sell it at a higher price. So you can actually, it's the same thing as exercising. You could either buy or sell the actual option or exercise it, and basically it's the same thing. So, but yeah, you're exactly right. You can benefit from that intrinsic value, and that intrinsic value goes up when prices go in your favor relative to the strike price, whether it's a put or a call. But this gets to the intrinsic value, or not the intrinsic value, but the time value, is if the markets are very volatile. And in fact, most of the traders that are trading options on the Chicago Board of Trade or Chicago Mercantile Exchange, they're trading volatility. So they're making forecasts. They're thinking about what that volatility is going to be in the future, because options prices go way up when volatility goes way up. I have a colleague that's an extension economist in the Midwest, and he works with a lot of cattle growers. And he always, talks about using option strategies for these guys. And what happens is it just doesn't pencil out right now because of the high volatility in the options premiums. It just becomes expensive. That's the bottom line. In fact, I even show that in my classes. I often show them, here's what option premiums were back in 2000, and here's what they are now for the same commodity, and it's almost double, in some cases triple, because of the underlying volatility in the marketplace. And so that is a definite con of an options contract. For some contracts, also there's very low liquidity, and especially the further you go out trying to use an options contract, the liquidity can go down, even though they are exchange traded. And they are complex financial instruments. I mean, probably the biggest thing in futures and options, keeping people from using them, is they're complicated. As Dr. Zilberman said, it's tough, it's complicated. And to really do this effectively, you really have to do your homework, be in the game, and have that knowledge. And so it is, that often scares people away, and that's often why people will do more forward contracting arrangements with, let's say, a cooperative or a bank. I have a colleague at a competing bank that does risk management strategies for their customers and customizes those things for their customers and as a service to them, because they're just in a better position to do it. So some of the common perceptions of futures and options markets, and I'm guessing some people, this has gone through some people's minds, are, the public thinks, oh, these are just gambling havens. I mean, I pulled these off of Google Images. I love Google Images. You just type in a phrase, and then, I typed in risk. I typed in moral hazard one time, and my name came out. But anyway, it's an insurance joke. So common perception of futures markets, it's Las Vegas. It's gambling. And talking about regulatory environment, the regulators right now are saying, hey, it's speculators are screwing up prices. They're messing things up. The index funds are, they're creating all this volatility and messing things up. And I have my personal opinions about that. But these markets are important. They're important for risk management. They're important for forecasting prices, or this concept we call price discovery. And the thing that's probably in most people's mind right now in terms of futures and options, and talk about a risk that no one or the data would never have thought about, is MF Global. And MF Global, in essence, took, a lot of farmers, in particular in the Midwest, had their brokerage accounts with MF Global. And their margin money just disappeared. And no one knew where it went. And that's a risk that, unfathomable. I would have never thought about that. And I think it actually put a really bad light on futures and options contracts that didn't need to be. It happened. And I really believe it was a one-time event. But what happens is when something like that happens, what does it do? It spurs regulation. So there's likely to be this whole new regulatory environment, and perhaps it's needed, but it probably is likely going to be overkill as well, and potentially stifle some of the good things about these markets. Forward contracts. Forward contracts, if you go back to Blank, I think I cited it in the paper that I wrote, Stephen Blank survey back in the 90s was really good. And one of the other things he talks about is how California producers have forward contracts available. And forward contracts have been mentioned several times today. And in essence, forward contracts are really a simple thing. And when I used to work at the produce house, we were engaged with a lot of forward contracting with large supermarkets in terms of them running sales. We would contract the peach price ahead of time with them and agree upon the price and agree upon amount of a commodity to deliver. So this really remains probably one of the most flexible and important risk management tools available to the real diversity of California agriculture. Some forward contract pros and cons are, again, you're locking in a price. You're locking in a price. You can lock in a price. There's no basis risk, so that concept of basis risk that we talked about earlier with futures kind of goes away with a forward contract. You agree upon a price. You agree upon the quantity that's going to be delivered in the future. And they're customized. They're over-the-counter. They're just agreements between two parties. They're customized. You can customize them for any sort of amount. Where with futures and options, you can't customize them. Those are very standardized products, exchange-traded, no customization. But very, very, very customized products. And it secures a market outlet. And I think this is an important thing for people to think about, is not only does forward contracting fix a price, it secures a market outlet. You know that, hey, I'm going to be able to sell X amount of commodity into this particular market outlet. I don't have to rely on the whims of the open market at a particular time. And it's applicable to numerous commodities. Again, you just have to find another counterparty that's willing to engage. And they can be mean enhancing in the long run with good price forecasting skills. So what I mean by that is it may not be optimal all the time to engage in a forward contract, especially if your expectations or prices are going to go up. Maybe you just forego locking in the price or design the contract such that you can allow some sort of optionality in the contract. But that may come at a price as well. Some of the cons of a forward contract: limited upside potential. Just like a futures contract, you're locking in a price. So you're foregoing price increases unless there's some sort of clauses in the contract that allow some sort of escalator clause or something of that nature. And then the other issue is counterparty risk. And this is not a risk this one's a difficult one to measure, definitely. This is one of those type of risks that go outside our data, that go outside our price and quantity data, is counterparty risk. How do I know that the counterparty on the other side of the transaction, except based on experience, is really going to fulfill their obligation? A lot of cotton merchants and other merchandising organizations were hit hard by this. Here's a farmer that says, hey, I just don't want to fulfill this obligation because prices have gone from 80 cents when I locked in that forward, to $1.50. And I don't want to, so I'm not going to deliver. Well, wait a second. Hold on. There's a breach of contract. There's legal things that can get involved, but unlike an exchange-traded product, it's a little difficult. Yield shortfalls. If you have a bad yield shortfall, a farmer may have a reduced ability to actually deliver the product, and they still may be obligated to deliver that product. So that ultimately gets back to counterparty risk. I think that was it that I had for there. And then, so the final tool that I want to look at is insurance. And, federally, at least in the current policy environment that we're in, and that's obviously changing on a daily basis as the Farm Bill goes through various iterations through Congress and so forth, is the concept that federally subsidized insurance, probably has the most applicability to California agribusinesses. Lots of options available for crops, livestock, new pilot programs in revenue, margin insurance, current policy environment favoring insurance as well. We'll talk about that towards the end. There are lots of insurance products out there for various crops and so forth. So I want to focus on a couple of them. And the reason for my focus is I want to show a little bit of a case study or a simulation for a naval orange operation in the San Joaquin Valley. So one of them I want to look at is this actual production history. And I'm guessing most of the people in this room are probably much more astute to the day-to-day of crop insurance than I am in terms of how a grower signs up for it, the deadlines they have to meet, and so forth. But I really want to look at it from the risks being managed more than anything else. So actual production history is, it's basically your basic multi-peril crop insurance. It protects against yields, against yield shortfalls in particular. And so, I'm going to probably truncate this a little bit, just given time, and I want to make sure we leave plenty of time towards at the end for some discussion. But the whole idea of APH, or actual production history, is that we ultimately have some sort of yield guarantee. And that APH yield is based off of the farmer's yields. So the farmer actually has to produce yield information, and at least in most cases for California crops, have to produce that yield information anywhere from a 4 to 10 year history. And then they choose a coverage level. So they may not cover all their yield, they may cover 70% or so forth. So they have a coverage level. And so if the actual yields are less than this guarantee, then an indemnity is paid. And then the indemnity is equal to whatever that yield guarantee is minus the actual yield times the price election. So the grower has, in conjunction with their crop insurance agent, can choose the price election and the coverage level. And those are the things that are really going to, more than anything, and as well as the yield, really determine what the price of that insurance is going to be. So you can go all the way down to cat insurance, the catastrophic, which if you go down to those levels of coverage, which I believe is like 50% for the yield guarantee and about 50% for the price election, that's 100% federally subsidized under the current Farm Bill. So that's basically free disaster insurance, and then you have to pay a $300 application fee or something. So I think I've talked about this already. Again, the coverage level and price election are going to be the major determinants of the premium, and then the premium's 100% subsidized for the cat. Actual revenue history then is another type of insurance product. That's important. And one of the themes that's come up continually today is thinking about the margin. Let's think about managing multiple risks at the same time, so to speak. And this gets us, thinking about revenue insurance now gets us closer to that concept. And that's an important concept in this global idea of enterprise risk management. So the previous product we looked at, APH, just covers yields and yield shortfalls. Actual revenue history now is really total crop revenue. So now so what this does is it does the following. It really takes into consideration, basically prices and yields at the same time, and it takes into consideration that natural correlation, typically negative correlation that exists between prices and yields. So the basic formula, it's really more simple than the APH example. The revenue generated, you take whatever the historical revenue is for a particular crop, and you multiply that times the coverage level. The payment factor is a scaling kind of factor that impacts the price of the insurance. So if the actual revenue is less than whatever that revenue guarantee, there's an indemnity, and so that indemnity is just the difference between what the revenue guarantee was and the actual revenue. So it could be a price decline. A price decline could cause the actual revenue to go less than the revenue guarantee. It could be yield decline. It could be price and yield decline. And so really this is, in an insurance policy, remember, it's very much like an option in that it truncates the downside and lets the upside run, so to speak. And that's an important thing to think about. Catastrophic, you can get catastrophic insurance, 100% subsidized catastrophic insurance at I think 50% coverage or so. Adjusted gross revenue, this is not, another thing I want to talk about really quick with actual revenue history is it's only really available for 4 crops. Strawberries, navel oranges, cherries, and there's one other one. I keep slipping which one that was. So this is really very much, and this is important to note, crop insurance is still very much in the pilot stages by the Risk Management Association. Or the RMA. So this is still in the pilot, but it's a really neat concept. And I think it's an important concept, and likely with the new Farm Bill, we're probably going to see more revenue insurance products coming. But it's only available for a few crops right now, where the APH, the actual revenue history, or excuse me, the APH insurance, the yield insurance, is available for lots of crops. Adjusted gross revenue it kind of takes the crops out of the picture and says, hey, let's insure all of the revenue for the farm. Very much in the same way we did the previous revenue example. The problem with this in terms of subscription rates is that they've been very low because farmers have to show their Schedule Fs. They have to provide tax returns and tax return information. That's what the revenue is based off of, which, and I believe Dan initially today was talking about accrual-based accounting versus cash accounting. And, at the end of the day, those tax return revenues are probably not really reflective of what's really happening from a managerial perspective. And the bottom line is farmers don't want to turn it over to any sort of government agency. I see somebody laughing back here. He understands this. So it's a neat concept, but it's seen low subscription rates in terms of a really interesting product that is out there right now that, again, this is in the pilot stages, is the livestock gross margin insurance. And this is the closest thing that's out there on the marketplace that actually hedges or locks in total gross margin. And I mean, the ultimate thing to do is not just protect prices or revenues, that's kind of the progression, but let's protect the entire margin, which considers costs as well. So in essence, what the livestock gross margin insurance does is allows a dairy producer to lock in a milk price, in essence set floor prices for milk, as well as set a ceiling price for feed inputs based on, and they have to report what their feed usage is and so forth to the RMA or to their insurance agent. And there's some calculations and so forth that go on there. But in essence, it's doing the same thing. You could do the same thing on the futures and options markets, but it takes a lot of those complexities away from the individual grower. Now the grower it basically has an insurance contract. They don't have to deal with margin requirements. They don't have to deal with understanding options. And so this is really an interesting service that the RMA is currently providing. This can be provided also privately. I know that there are firms out there, especially in the dairy industry. There's a couple of outfits that I've worked with in Chicago that pretty much offer this product to their customers. And they'll design and customize a risk management strategy that looks very similar to this gross margin insurance concept, where they're in essence hedging corn as an input or soybean meal as an input and milk prices as outputs, locking in that margin. It's a neat concept. It really is a portfolio concept because it considers multiple risks at the same time. And one other interesting product out there is this livestock risk protection, which is just a price insurance, but for feeder cattle, live cattle, and so forth. A couple really quick, because I want to get to the simulation and have some time for discussion. Some pros and cons of insurance. Broad commodity coverage. It provides downside risk protection. Revenue insurance, which I think is an interesting idea. It covers both prices and yields. Subsidized premiums, at least under the current market environment. They're flexible, and the cat is basically free. Limited revenue products out there. Revenue products are cool. I'm going to show that here in a second. But there's limited products. It requires really solid record keeping by the grower in terms of prices, or in terms of prices, yields, and revenues. Paperwork and deadlines could be a little cumbersome. You always pay that premium. But again, hey, I don't ever want to use my life insurance policy either. And sometimes potentially some low participation rates that could ultimately jeopardize the future of some of these things. The final thing I want to do is I want to show, how I want to talk about this concept of simulation, because this wraps us back to the first thing I talked about, which is risk measurement. And I think this is a great little cartoon because it shows a farmer behind multiple computer screens. I mean, this is a sophisticated farmer, and this, I think, is very reflective of today's market environment. Multiple computer screens. I'm still trying to figure out how to use one computer screen, but all my colleagues now have two. I think it's kind of interesting. But I'll stick with one. So simulation, how is this likely to work? How are these things likely to work? So I picked a case study for a Fresno County navel orange grower, and I use a program called At Risk. And I don't know if anybody's familiar with this. It's an add-in software to Microsoft Excel, and allows us to do what's called Monte Carlo simulation. So we can actually make certain things variable and see what the resulting outputs potentially could be. And so I did this simulation in that. So what I did was for the Fresno County navel grower, these are based on NAS data. I took their prices, a historical series of prices, and historical series of yields, and I defined a statistical distribution for each of those. And we won't go into the hairy details of that. But what it does is it draws randomly from the price, and it draws randomly from the yields, considering the correlation between prices and yields. That's what the simulation does. It pulls the price, it pulls the yield, it creates a revenue, price times yield, and it considers that correlation. So, and it does this 5,000 times. I set the simulation. You can run it for 10 times, 100 times, whatever. I did it for 5,000 times. So what that does is it really picks up every random combination between prices and yields under this correlation. And it gives us a big distribution of ultimately what the resulting revenue would be under that situation. So it's a way to think about it is if we had 5,000 years of data, what would the world look like? What's our kind of best case, worst case scenarios in this world? And so we really want to examine those risk measures, both without a risk management strategy and then using various risk management strategies. What would this potential outcomes look like with no risk management versus risk management? And I think this is an important aspect of practical risk management, is to think about this. So I generated a couple of rules. One is a forward contract. If the beginning season price is greater than long run average, we're going to lock it in at 482. I'm going to skip through some of these details, and then we're going to use I'm going to skip through these details here just out of time. We use a yield insurance. We use a yield insurance where we basically lock in the average yield of 596 cartons per acre on a 75% yield guarantee. For a price, and I do consider the price of that insurance, I estimated that from the risk management agency at about $144 per acre. I then combine a forward contract with yield insurance. So hey, let's manage the risk of yields and let's manage the risk of price through a forward contract. So I do both of those. And then I consider a revenue insurance product because there is a revenue insurance product for navals. So we consider that revenue insurance product as well. And the revenue is basically the average revenue based on the average price times yield over the long run. Here's what's really interesting. If we go back to think about the risk measures that we talked about, at no risk management, our standard deviation is $185 or $805 per acre. The mean is $2,800 per acre. The value at risk is $1,739, which is the 5%. There's only a 5% chance that revenue would go lower than that. But the absolute minimum that occurred through this simulation was $541 per acre. That's a bad outcome. I mean, granted, we looked at 5,000 potential outcomes. Let's go way out here to the extreme of revenue insurance. And what I'm trying to get at is revenue insurance is pretty neat from a risk management perspective. What the revenue insurance does is look at the difference in standard deviation, which is that spread around the mean. It reduces that standard deviation considerably versus no risk management. It also is it also slightly reduced the coefficient of variation, which means it was a little bit, if we look at risk relative to return, it was a little bit mean enhancing. The biggest issue, however, was look at the downside risk. The downside risk was basically truncated to $1,981 per acre with the revenue insurance. With no risk management, it was $1,739. So that means there's a 95% chance under these 5,000 simulations that the revenue is going to be greater than this. Look at the minimum. The absolute worst case scenario that occurred was $541 per acre. Look where it was with revenue insurance. It was truncated at $1,981, which is basically whatever that revenue guarantee was, less the premium. That's important for risk management. Because what it really did was it cut off those bad outcomes. It reduced the overall variation, and it cut off the bad outcomes, that revenue insurance. I'm a fan of revenue insurance. I think that revenue insurance is a really interesting idea. So some random thoughts, because this is all about random variation and so forth. I used to work on a farm in California, and I worked in a vineyard. And the gentleman I worked for was the principal at my high school. And so I used to get called in all the time to the principal's office to know which rows I was going to plow that night. And I used to say he was not a good risk manager at all because he hired me to drive tractor. And I used to take out rows, and I'd have to come to him and say, I'm so sorry, I put the disc too close, and I just wiped out row 35. And before I looked back and said, oh, they're all gone. So anyway, I needed to say something that wasn't related to distributions. So that's why I mentioned that. So what did we learn? We learned about defining risk and risk management. It's really critical. Risk versus uncertainty. What are some of the pros and cons of various risk management tools? I think that we learned that as well. In particular, it's important to think about, what's the appropriateness of the tool and what's your risk appetite. It very well may be that there's risks that we're just willing to tolerate. And maybe we have the capital, hopefully have the capital to absorb those risks if we need to. The insights from the simulation. The insights from the simulation basically say we want to think about there's some benefits to risk management. In particular, if we think about these pilot programs of revenue insurance, those have a lot of potential. But the true risks may go beyond the historical data, things that we've never thought about. The MF globals. No one ever thought of that. No one ever thought about September 11th. I mean, these are risks that we don't think about, and they go way beyond our data and our ability to measure. Some other tools that are out there on the frontier are weather derivatives. How could we potentially use weather tools to hedge yield risks based on just weather phenomenon alone? And there's a lot of talk about weather derivatives, but they haven't been subscribed they're a growing subscription, not that much in agriculture. Diversification, risk absorption, self-insurance is important. The future of risk management, I think, just in general, the Farm Bill is going to push more towards insurance, and that's clear. Less direct payments, more towards insurance, more towards understanding risk management. Lots of interesting pilot programs, I think, that are going to occur. In particular, for instance, index-based weather insurance, which we can talk about more here at the Q&A if you want. There are some exchange-traded and swap opportunities that I think are out there. I know some banks are offering this to their customers. And so they don't have to hedge directly. They're, in essence, indirectly hedging. So what has been your experience, insights, questions? That's you know, and I say that because it's just interesting to hear, you know, everybody's probably had some experience in these things, and it'd be interesting to hear what people have to say. Any questions, comments, concerns? Yes?
I look at crop insurance for cherries, blueberries, and citrus. Also for almonds and pistachios, but not such an issue. We sit there and we agonize over crop insurance because the owners, when something happens, say, we're insured, right? And my gut and I'm an English major with a law degree overseeing
Right.
farm operations, you know, but we've sat there and we look at the premiums and a big part of it is how many acres are considered in your unit. And I don't know if that is factored into your analysis. So the larger block that's covered by that
Right.
insurance, because it's contiguous, the more loss you have to suffer
To
in
get the
order
payoff,
to
yeah.
collect. So my analysis, and I read, you know, up quite a bit and all that, because these are huge decisions that I'm making, are that for a large farming operation, you aren't going to recover. A small farming operation or smaller pieces separated by geographical area, you have a better chance of recovering. But to write a $300,000 premium when I would have to lose at least 50% of my crop, and historically
Right.
that just hasn't happened, it's a tough sell for me to write that check.
Right.
What is your, I mean,
Well,
did you
I think
look
that
at the actual?
Well, I mean, the simulation I did in terms of the pricing, I had to put everything on a per acre, so I, you know, to keep it pretty general. So no, I didn't consider in that, you know, the size and scale. But that's a good point. I think that, you know, I can't. Somebody was at Iowa State, and I can't remember. Basically, said the same thing that you did. You know, crop insurance may make more sense for a smaller producer than it does for a larger producer. That gets to almost thinking about weather insurance, because if you know, the idea behind a weather insurance product is that the premiums would be considerably cheaper, and that you can actually have broader coverage potentially based on weather stations, and you know, maybe avoid that constraint because the premiums would be considerably cheaper under, you know, theoretically anyway, under something like that, where you can actually use some sort of weather derivative that link that to the exact yield losses or just differences in yields that may not be that drastic, may not even be losses. It may just be yields enough to drive my income down, and I can hedge that versus, let's say, you know, a disaster that has to occur.
Well,
The question becomes under CAT, are they even able to get that, the catastrophic coverage?
We do CAT because at that point, if I've lost 50%, I'm at the catastrophic anyway.
Right.
And it's worth the $300 in the
Right.
forms.
Right.
But the other thing, going back to the revenue insurance, if my yield is down, supply and demand, my
Right.
price is up.
Right.
Cherry crop this year
Sure.
is a perfect example in California. Yields are down, prices are fabulous. And so you still don't score with the insurance. Now, I'm not looking to farm insurance, so that's okay with me, but again, it just makes it harder to collect when I'm sitting there thinking, do I spend $300,000 on
Right.
crop insurance or equipment or something else?
And that becomes, I mean, again, that gets almost to the case of a risk appetite idea in terms of how much, you know, probably someone that's in the cherry business is probably a risk taker anyway.
They're a risk taker.
Right? I mean, if you're in the cherry business, you're willing to take risks. So it really becomes their risk appetite. Are they willing, if they really want that downside protection? And again, I'm thinking on the per acre basis, not the scaling issue is an important issue that you bring up, and something I wasn't overly aware of. But it, you know, really becomes down, you know, an issue of their risk appetite. What are they willing to take? If they're saying, hey, I'm willing to take the bet that prices are going to go up, and I don't want to pay that premium. The old adage in risk management is it's the pain of inaction. It's when if something did happen that now I need to collect, then that maybe that $300,000 was worth it now.
And when I'm sitting there making
Right.
the decision, I have to be prepared to look them in the eye and say, at the time, this seemed like the right decision.
That's right.
So
That's right. And then at the end, and the thing is interesting with insurance is, in theory, you never really want to collect on it, right? I mean, I don't ever
Right.
want to collect on my car insurance. I don't want to collect on life insurance. So it literally is a safety net.
But
from a
what
pure risk management perspective, the revenue insurance products are interesting. But, again, it becomes how much how much coverage do you want? In this example, I took the coverage way up. I mean, it was a 75% coverage. How much versus the cat do I want to, in essence, invest in the premium? Because you aren't going to get that premium back. You always have to pay that.
Right.
So.
But from your lender, I mean, my lender calls, my crop lender, and
Mm-hmm.
says, hey, just want to make sure you send me copies of whatever crop insurance you get. And
Right.
I have older farmers in the organization. It's a family farm,
Mm-hmm.
so the father-in-law, and he's in his 80s, 20 years, 30 years of buying hail insurance in Arizona because his lender required it.
Right.
Never once collected, never once made it worthwhile. So that's one of those where it seems to make everybody feel good. But
Mm-hmm.
I was thrilled to see your presentation because I would love someone to tell me either yes, it's worth it, or no, you're right, it's not going to pay off.
And again, I think that's really that's an individual question, and the variables of how much coverage you want versus the coverage level, how much yield you want to protect, or how much revenue you want to protect.
Right. We look at,
all
are
those
we
things.
covering our expenses, or are we insuring our profit? And we
Right.
take the philosophy we're going to cover our expenses.
Okay.
But-
right. As a worst case
Right.
scenario. Right. And that's logical in that regard, and that probably lowers the premiums as well.
Right.
I don't know if I answered your question or not. I mean, I think it really does. I mean, depends on the individual, the risk appetite, how much they're willing to absorb. Like you said, the cash flow could be used for other things, so they are absorbing the risk if they don't engage in the contract. But right. Mm-hmm. Right. Mm-hmm. Right. They're not going to do it. There was a presentation I saw recently from out of, I think I mentioned it earlier in your question, out of Iowa State, that basically said the same thing. That risk management and crop insurance should be marketed more towards like the type of entity you just described. If you're big and you can absorb it, it may not be worth some of those premiums. So was there another question? That's awesome.
No, I think the point that you raised is true. If you don't have subsidized insurance,
Right.
then basically, if you can absorb it, then you basically make the money that the broker makes. The thing about the crop insurance that we have now is that they are subsidized. So
Right.
in many cases, I will take 75% because to some extent,
Right.
you get a gift from the government.
Right.
But it's not an insurance that any private insurance will, insurer will give you. But really, if you are not small, then don't take it. Now, the other thing is owner versus manager. If you're a manager and you have a bad year, then you will be fired because the owner doesn't know if it's your fault or God's fault. So a manager will take insurance because basically because it's better to make a small loss than a big loss. But if you are the owner, basically, and you are big enough and it's not subsidized insurance, don't take it. That's my personal view.
That's interesting that you bring up the management perspective because if you look at the premises of enterprise risk management, one of the things is enterprise risk management says, hey, one of the jobs of management is to manage risks, and it's perhaps because of that manager's objectives in terms of if they don't manage the risk and things go bad, they get fired, but the owner doesn't get fired. I guess they go out of business, but not get fired. But you're exactly right, and then. Okay.
All right.
Any other? We're good. Any
Yeah,
other
good
questions?
timing.
Okay.
Thank you so
All
much,
right,
Dr.
thank you.
Manfredo. All right, we'll take a break of 15 minutes, and we'll be back at 3:15.